We'll start our review for Wednesday, January 15th. Day had a big gap up, and then we had a few legs of follow through, and those legs of follow through ended up being a wedge pattern. So you can see this first push, second push, and then you can call this a third push, was subdivided into two different parts here. So 3 pushes, decent bear bar that's far from the moving average. I think at a minimum you should be getting out of longs if you'd bought anywhere from here. Then you want to go ahead and get out below that bar. But it's also reasonable to short below that bar. And you can go for more profit than 2 times. You can make a bet that it'll try to come back and try to test the high of the previous day, or likewise we'll have a measure move down from the opening range, and it'll break out and come down here. You can bet on that. You have to realize your probability is lower. When you do win, obviously that's going to be a huge win, and that would be a 70-point trade if you were able to get that. But your odds of getting that are lower. So I think what probably best for most people is, if you're taking this short, try to get out at 2 times your risk, or try to wait for the pullback to the moving average and get out there. Or if you do feel like the market will have a larger drop, you can get out maybe only half of your position, and then try to swing trade the rest and ride it out. Hope that this will be the high of the day. So what I'm gonna do in this video, I basically have three different important points that I want to talk about, and then I'm going to pull up the 2000 tick chart and talk about those. So when you're watching these certain changes in the day, then we can pull up the tick chart and look at opportunities there as well. But I'm going to go through the 5-minute chart first, then we'll go over and look at these 3 different points. So as the market is moving lower, then we do get below the moving average here. And most of the shorts that I take are going to be below the moving average, and most of the longs are going to be above the moving average. So like getting short here, it's kind of meeting at least one of the criteria, which is it's a bear bar closing near its low, below the moving average. So at a minimum, even though this trade would have lost, at least you're looking at trying to follow the rules and meet the criteria. If you are taking this short here, all right, it's a breakout, pullback to the moving average, and then trying to go lower. And you can look at these tails. You can call this a double top here. On a lower time frame, this is a double top at the moving average. So I like the idea of trying to get short there. And on the tick chart, I did try to get short somewhere in here, and it basically just took a small loss, somewhere in here. But if you are getting short in this, are you going for a scalp or for a swing? Well, I think you need to be going for a swing, and the reason is that you're coming right into these lows over here. So if you're going for a scalp, say 5 points or 10 points, you're asking for a lot when coming right into these lows. When you're already at the lows, and if you're taking a short at the lows, it's probably better to bet to go ahead and bet on the breakout. And if you're betting on the breakout, which is low probability, then you need higher profit to offset that lower probability. So 2 times your risk, and I think that's okay. It'd probably be even better to go for more than 2 times your risk. Especially considering we do have this possible measure move down of the range. So if it breaks out, I would expect to make a fairly deep move down here. So I would want to go for a larger swing trade on that and avoid trying to scalp below that. As the market starts to move back up, you notice what we get. We get gap here, gap here. Now this gap here does close when this market pulls back. However, you can notice that now we are above the moving average, and we're staying above the moving average. So as these gaps form, they are being closed several bars later. But I think what's important is that they're forming at all, which is good. And then the pullbacks are happening, but they are staying above the moving average. So we're getting gaps. We're staying above the moving average. And, what my mind goes to there is, okay, it's time to start looking for longs and looking for ways to get long. A couple ideas I was thinking about when I was trading this live. One was I saw these 3 bull bars all closing near their highs, decent sized bodies. And we did have these gaps. So by the third close here, I was thinking this could be considered all just one large bar, and it's trapping traders that were short here. This is where they're getting trapped. So I was interested in trying to take a swing above this, and we got close there at the end of the day. So, you probably would have gotten out somewhere either below this bear bar or below this bear bar. But, this would have let you hold on for most of the day and gotten quite a decent profit there. So after those 3 strong bull bars, I was thinking there's probably going to be more up, and I was interested in looking for a swing trade there. Another thing that happened here and I'll give you insight into what I was thinking live, was this bear bar. It's a fairly large bear bar in a bull trend, and it was a bit of a surprise. So I think this definitely made some of the bulls concerned, right? Because as this forms, it's a very large bar, and the bulls are getting worried after that. They're saying, well, that's a pretty deep pullback. Is the market changing? Is this just some kind of wedge here? With these 3 pushes, and then this is reversing back down here. So that's what was going through my mind. And then I started to think, well, this might be a bear trap. Sometimes in a bull trend, you'll get a surprising bear bar that just ends up reversing. And that's what ended up happening. So, the bears were trying to make bulls think that this was a bull trap. The bulls were going to be trapped up here. But it turned out that the bears were trapped. All right, market's moving up. We're still staying above the moving average. And then we get this great looking bull bar. So at the close of this bull bar, I was thinking this bar is a bear trap. We're probably going to get more up. So perhaps you could buy above that bull bar. And, I'll go ahead and mark that as well. And if you are taking that, since it's a trap and since there's a surprise, I think you should be looking for a swing instead of just trying to go for a scalp in a few points. I think you should be swinging above that bar and betting on, higher prices. And similarly here, with this pullback here, now we have a second entry. So first entry is happening here. Another pullback, second entry is happening here. So second entry long above the moving average. Bears are trapped, so market's probably going higher. Notice also that this bull bar here, you'll notice that the market pulled back, had about a 50% pullback on the size of that bar. So 50% pullbacks right here. It came right back down to that and then reversed up. And you will see that sometimes when you get a surprise bar like that, then you'll get a 50% pullback of just that bar before heading higher. So let's go ahead and look at the 2000 tick chart, and we'll look at these same entries and talk about how you can look for opportunities on the tick chart. All right, so first, remember, we were talking about this wedge on the open and then this bear bar. So when I'm seeing this, I'm thinking we're probably having lower prices. And so one way you can do this, swing over to the 2000 tick chart and look for shorts on that. So this is where that wedge formed, and then that bear body. So once we get that, I'm looking for shorts below the moving average. Notice I didn't say I'm looking for longs. I'm not looking for shorts above the moving average. I'm looking for shorts below the moving average. And I have one marked here. And then when you're taking this, remember on the 5-minute chart, we're thinking we're going to have a deeper pullback back to the moving average. So I want to try to be swinging this. You can go for 2 times. Or if you think your probability is low, I'm going to go for 4 or 5 times. And that you do that to offset your lower probability. And I marked this, so really a lot of these cells through here would be okay. And it did kind of go sideways here for a bit. So some of these that you take might end up as losers, but the big picture, you're going to have a lot of winners here. And especially if you do go for, like, if you just take one and go for 4 or 5 times your risk, if you took this first one or this second one or this third one, then you're going to get out somewhere way down here, and that's going to be a great win. And let's say you shorted here and ended up losing on this. Then if you short again below here and are going for 2 times or 3 or 4 or 5 times your risk, you're going to get out way down here, and that huge profit's going to offset those couple of losses. Then I marked a couple more shorts down here, and let's go back to the 5-minute chart. So we already looked at this. Now on the 5-minute chart, we're below the moving average, and we do have a gap here. We have a gap, pretty strong close below the moving average. Now we're getting double top and a bear bar. So all through here, I'm trying to think, how can I get short and look for swing trades? And so that's what I have marked here. This first short, this is a second entry short at the moving average. All right, so we have this sharp sell-off, and we do have these several bars back here. So I'm probably going to, first of all, there's not an entry here anyways, but I do think a second entry is better to wait for than, so you get a second entry here, and notice how I'm defining the first and second entry. We don't have to have actually like a bear bar to consider it a first entry. You just needed there to be a pullback below a bar. So this pullback here is the first entry. And then you get this second pullback, that's the second entry. And so I think short and below there is reasonable. Once again, going for a swing trade. You would have been stopped out there. So then now, looking at the price action during this area, we're at the moving average. We can tell there's a bit of support and resistance through here. You can see like there's a distinguishing line here. We have these highs here, breaks out, and then when it pulls back, we see the bodies kind of close around this price. And also we have a smaller double top here. And then the market's getting back below that sort of support and resistance and the moving average. So when I see that, I'm trying to get short below that. Right, the bigger context is bearish, and then we're also having this more technical move where I can look to get short below. So you lose here, then you make it back, and then some shorting during here. Now this bigger picture, this was a bit of a bear trap here. Then as the market starts to break out above the moving average, and then we're clearly starting to hold above the moving average, and then it's clearly starting to get long, and then bears are starting to get trapped during here, then once again, either I'm looking at the 5-minute or I'm looking at the tick chart and trying to find swing trades long on the tick chart. So let me go over to 105 was this bar. So pull it up on the tick chart. And I do have some other trades marked through here. There's 105. Okay, so as of 105, we're thinking long. We're looking for buy setups. I have this marked, and I like buying here for a swing for several reasons. One, we are in the bigger picture, we are moving up, and also you can see we have another sort of head and shoulders bottom here. Left shoulder, head, right shoulder. Another way to look at it is basically we have this support and resistance across here that we attempted here, then broke below here, then pulled back above, and now we're holding above it and above the moving average. So when I see that pattern in confluence with the 5-minute chart that's moving up, I want to be trying to find swing trades of a bar like that. And wouldn't even, you're out pretty quickly over 2 times. And like I said, if you really think the market is strong, then look for more than 2 times your risk and go for 4 or 5 times your risk. And when you do get something that's 4 or 5 times your risk, then having that like 30, 40 point trade is definitely gonna change your math on your profitability. Looking at this entry here, it's kind of the same idea. Really, the market's just moving up, and we're holding above the moving average, and that's what I'm just trying to do. Trying to get long above bull bars, above the moving average. You can also see we have this support resistance through here, and we're holding above that. So that's also good to see. Here, this entry, you can tell we kind of had this channel up through here. Then when the market breaks below a channel, 75% of the time it's going to try to test the high of that channel. So we have that working for us. And then also it's still just a pullback in a moving average, a pullback in a bull trend at the moving average. Some might argue it's better to wait for a second entry here after we have had this deeper pullback. But once again, if you're concerned with your lower probability, then increase your reward to offset that. So at a minimum, be going for 2 times your risk. But here we can see clearly, 4 times would have gone out up here, and you would have been fine. Really had no pressure even. It would have gone straight up for you. All right, so if you made it this far into the video and you liked what you saw, then consider subscribing, and then you'll see these reviews on most days. And then, of course, I make other videos as supplements that are trading related and will help your trading. So, guys, thank you for watching, and we'll see you next time.